Welcome to our explainer on the balance of payments theory. In this video, we'll dive into how a country's balance of payments is influenced by trade balance, capital flows, and exchange rates. Let's start with the basics. What is the balance of payments? The balance of payments, or BOP, is a comprehensive record of a country's economic transactions with the rest of the world over a specific period. It includes trade in goods and services, investments, and financial transfers. Why is the balance of payments important? It provides critical insights into a country's economic health and stability, showing whether a nation is a net lender or borrower to the rest of the world. It can also highlight potential economic vulnerabilities or strengths. We'll cover three main areas: the trade balance, capital flows, and exchange rates, examining their roles and significance in the overall BOP framework. By the end, you'll understand how these factors interact and shape a country's economic destiny. Let's begin our journey into the fascinating world of balance of payments theory and see just how integral this concept is to global economics. Welcome to our exploration of the historical development of the balance of payments theory. Over the centuries, this pivotal economic concept has undergone significant transformation. Early economic thinkers, such as mercantilists, laid the foundation for our modern understanding, believing that a nation's wealth and power were best measured by the accumulation of precious metals. As economic theories evolved, the focus shifted toward the flow of goods and capital. Prominent figures like Adam Smith and David Ricardo introduced groundbreaking ideas about trade and comparative advantage, reshaping how we assess national economies. In the 20th century, economists like John Maynard Keynes and Milton Friedman further refined these concepts, incorporating aspects of government policy and market dynamics. The balance of payments theory reflects this rich history, tracing its roots from early assumptions about wealth to sophisticated analyses of trade balances, capital flows, and exchange rates. Understanding this evolution offers invaluable insights into today's economic strategies and challenges. Now, let's break down the main components of the balance of payments. The balance of payments is a vital economic concept, broken down into three main components: the current account, the capital account, and the financial account. First, the current account covers the trade of goods and services, indicating the net export or import balance. It includes the exchange of tangible products, services, income, and current transfers. Next, the capital account involves capital transfers and the acquisition or disposal of non-produced, non-financial assets. It records the flow of funds for things like investments and the buying of fixed assets. Lastly, the financial account tracks net changes in ownership of international financial assets. This encompasses direct investments, portfolio investments, and other financial assets and liabilities. Understanding these components is crucial to grasping how a country's economic transactions with the rest of the world are recorded and analyzed. Now you'll see how the trade balance, one of the critical elements of the current account, impacts the balance of payments. Understanding the trade balance is pivotal to grasping the broader concept of the balance of payments. The trade balance measures the difference between a country's exports and imports. When exports exceed imports, a country runs a trade surplus. Conversely, a trade deficit occurs when imports surpass exports. This balance is a critical indicator of economic health and stability. A positive trade balance can boost a nation's reserves and strengthen its currency, while a negative trade balance might signal economic issues that need addressing. These fluctuations in trade balance significantly influence a country's balance of payments, impacting everything from currency values to international borrowing costs. Next, we'll explore how capital flows further shape the balance of payments and uncover the various types and impacts of these flows. Capital flows are essential in shaping the balance of payments for any country. These flows come in different forms, primarily as foreign direct investment and portfolio investment. Foreign direct investment, or FDI, involves establishing business operations or acquiring business assets in another country, such as factories. This kind of investment creates long-term links between economies and fosters economic growth. On the other hand, portfolio investment refers to the purchase of financial assets like stocks and bonds. Unlike FDI, Portfolio investments can be more volatile and can quickly enter or exit an economy, impacting the financial account and the country's overall financial stability. Together, these types of capital flows play a pivotal role in determining the balance of payments, influencing factors like currency valuation and investor confidence. Now, let's uncover how exchange rates further complicate this intricate balance. Exchange rates, which determine the value of one currency against another, have a profound impact on both trade and capital flows. When a country's exchange rate fluctuates, it directly affects the cost of goods exported and imported. A higher exchange rate makes exports more expensive and imports cheaper, potentially leading to a trade deficit. Conversely, a lower exchange rate can boost exports by making them cheaper on the global market, but make imports more costly. Moreover, exchange rates influence capital flows. Investors are attracted to nations with stable and strong currencies, while volatile exchange rates can deter foreign investment. Governments can adopt various exchange rate policies, such as fixed, floating, or pegged rates, each with unique implications for the balance of payments. Understanding these dynamics is crucial for grasping how a country's economic health is interconnected with global markets. Next, we'll explore how these principles apply in both historical and modern contexts, shedding light on the continual evolution of balance of payments theory. Let's dive into a comparative analysis of the balance of payments from historical and modern perspectives. Historical BOP data offers insights into the economic dynamics of past eras, highlighting the foundational principles and key economic activities of the time. Fast forward to today, modern BOP data reveals a complex web influenced by globalization, advanced technology, and sophisticated economic policies. By comparing these data sets side by side, we can identify notable differences and similarities. Historically, trade imbalances were primarily driven by tangible goods, while today's numbers are significantly shaped by services and digital transactions. In both eras, however, capital flows and exchange rates remain pivotal components. These comparisons help us track the evolution of economic thought and understand current trends more deeply. They also underscore how BOP principles remain relevant, adapting to changing global circumstances. Now let's see how this comparative understanding aids in analyzing specific countries' balance of payments, offering a clearer picture of their economic health and policy effectiveness. Let's take a closer look at the balance of payments of a specific country to see how trade balance, capital flows, and exchange rates interact. First, we'll examine country-specific BOP data to establish the baseline. This analysis will help us understand the components of the trade balance, identifying surpluses and deficits. Next, we will dive into capital flows, highlighting types such as foreign direct investment and portfolio investment and their respective influences. Additionally, we'll analyze exchange rates, exploring how fluctuations affect both trade and capital movements. Through this deep dive, several lessons emerge. We see how a country's economic policy decisions can impact its BOP, and conversely, how external factors play a role. These insights not only validate theories discussed earlier, but also provide a practical framework for applying them in real-world scenarios. As we move forward, you'll see how these findings integrate with broader patterns of economic management. By the end of this segment, you'll understand this vital part of economic theory and its tangible implications on a country's economic health. Managing the balance of payments is an intricate dance. Economic fluctuations pose a significant challenge, from recessions to booms. These economic shifts can wreak havoc on financial stability, requiring agile and effective policy responses. Governments must tread carefully, crafting policies that mitigate adverse impacts while fostering sustained growth. But it doesn't end there. The global nature of the economy means that challenges in one country can ripple across borders. Trade imbalances and capital flow disruptions can trigger far-reaching consequences, impacting economies worldwide. It's a delicate balance, requiring vigilance and adaptability. Policy responses must be robust yet flexible, targeting both economic stabilization and long-term prosperity. Countries continually fine-tune their strategies, learning from past experiences and adjusting to an ever-changing global landscape. Moving forward, you'll see how these challenges shape future trends and developments in balance of payments theory. guiding us toward a nuanced understanding of global economics. As we look to the future, emerging trends and technological advancements will continue to shape the balance of payments theory. With the rise of digital currencies and blockchain technology, financial transactions are becoming more instantaneous and transparent, impacting trade balances globally. The increasing importance of e-commerce and digital markets is shifting traditional economic frameworks, creating new patterns of capital flows and altering exchange rate dynamics. Automation and artificial intelligence are also playing a key role, optimizing trade logistics and financial forecasting. These technological impacts will require us to rethink conventional approaches, making BOP theory more dynamic and adaptable. Understanding these future trends is essential for economists and policymakers. They need to anticipate changes and craft strategies that best leverage these technological innovations. By staying ahead of these trends, countries can foster more stable and prosperous economies. As we conclude this segment, let's delve further into the exciting possibilities that lie ahead in the world of economics. Stay tuned for our final summary and a call to action to keep you engaged and informed. As we wrap up, let's reflect on what we've learned about the balance of payments theory. From its historical development to its modern applications, we've seen how trade balance, capital flows, and exchange rates interconnect to shape global economics. This theory helps us understand the complexities of international finance and economic policy. And while we've covered a lot, there's always more to explore. We encourage you to dig deeper, investigate further, and continue your journey in understanding this vital aspect of economics. Visit our website for additional resources, subscribe to our channel, and stay informed about the latest trends in economic theory. Thank you for joining us on this educational journey.